As long as COVID-19 is not contained, I don't see the markets recovering. Hey all, Choi Boy here. Today we're going to be talking about how you can invest your money during this recession maybe. I don't know. It seems like a recession to me, as I explained in the previous video. Please check it out if you haven't already. So I'll be talking about types of investments and how you could be investing your money based on how you invest in general. Talk about generally the market trend at the moment and what I think the market trend is going to do in the near future. It is purely my opinion and views. Please remember, this is not financial advice. I am not an expert. I am an amateur and I just love reading the news and all that kind of stuff, and I just analyze a lot of things generally, and hopefully it helps you in some way because it is a big psychological thing. I think it is worth listening to other people's views on it. It's your decision to take it in or not, but it is good to be exposed to people's views. So hopefully my view does help you. I got a presentation here ready, but before we go into that, generally why I'm making today's video is because a lot of people might be curious about the stock market because everything took a massive discount. Everything's like 50, 60, 70, 80% down, especially the ones which are directly impacted by coronavirus. And it's really important that you know the basics and what you are going to put yourself into when you join the stock market. Every financial crisis will bring a brand new generation of investors. Normally it would be, for this time, it would be millennials, and it will be very appealing because everything is discounted. Like for the past few years of hard gains, that's all been lost in the last month. Some companies lost the last 5 years worth of gains, some lost 3, some lost 2 years of gains. There's a wide variety of losses, but generally speaking, it's a good time to look at the stock market and people will be actually interested in it. So I think it was a time for me to talk about these things so you know what you're going to do with your money pretty much. S&P 500, it's seen some massive downtrend in the last month, but there has been some pickups for the past few days. I think this is mainly because of the US stimulus package, and you know, he's gonna pump trillions of dollars. Trump, of course. So I don't know what that's gonna do exactly, but my gut feel is that if they're not careful with that, they might cause overinflation. Few trillion dollars is no joke, and I don't know how serious Trump is taking the whole situation. By looking at the news and what he's saying on television, I don't think he's really taking the whole coronavirus and the global economy very seriously. I honestly don't respect him in that kind of aspect because he's been taking the situation very lightly, which caused things like this. So USA is at the top of the coronavirus case list. Now they finally overcame China, and Italy also came up on top of China as well in terms of number of cases. Just based on the facts we have in front of us, USA is the top of the list. Now when you see that, a lot of investors would get very scared about the financial markets and what it's gonna hold, because people will start needing money. A lot of people lost money in the recent correction, and the government is losing so much money. They're printing more money and everything is not looking so great. For example, in UK, you even got the leaders who are being contracted COVID-19. For example, Boris Johnson and Prince Charles are both positive on COVID-19. When your country leaders are positive on a pandemic disease or pathogen right now, then it's gonna create some fear in the general public. People start realizing how serious the things actually is. So I don't really have good, positive, optimistic views on the near future for the markets. I honestly think, frankly, the markets will have another dip. As long as COVID-19 is not contained, I don't see the markets recovering. It might be a few months, it might be end of this year, it might be end of next year, who knows. But yeah, as long as COVID-19's floating around still on the exponential growth levels, then I don't see the markets going up. I wish the number of COVID-19 can suddenly drop like that in the next few days. It's generally not the case. You'd see a exponential growth, then it starts easing off and it starts coming down like that. So that's generally what you are expecting, and obviously wanting the markets to go back up when a pathogen is wiping out the world, I don't think it's a reasonable explanation of if the markets are going to go up or not. So that's where I stand here. So let's talk about the presentation I have here. So this is how you can invest your money in the crisis. Now, what do? Everyone's crying, and a lot of people are very sad that they lost a lot of gains in the past month, existing investors. But this is an opportunity for existing investors to buy back low stock prices. But also it is an opportunity for people who always thought the stock market's too expensive for them, but they suddenly see 50%, 60% drops and they get very interested. And this is what's scary. When new investors join, they tend to be reckless. They tend to put their whole savings in. They tend to do a lot of stupid things. And I think it's really sad that so many people have bad reputation of the stock market because people don't research and learn about the basics before they come in, especially in Asia, in Korea, where I was born in. There's not a good reputation for the stock market, and that's because a lot of people want short-term gains and they put a lot of money, a lot of their savings, their net worth, and it's crazy. And so many people get burnt in Asia. DCA and stuff like that, that's not really an option, generally speaking, in Korea at least. They're normally buy low, sell high, but that's really hard to do most of the time. So they don't really know the risk involved in that kind of stuff, and I think it's really important you know all that before you come into the stock market. And I think Western countries are more well informed in that kind of aspect of safe investing and a bit lower risk compared to what a lot of Asian countries would be doing for short-term gain. So this is actually an opportunity because it's low, and all-time highs tend to be broken in the next few years or maybe in a decade. Who knows? But you're buying it lower, and that's all that matters, right? So let's talk about what are the options you can invest into in the current situation here. Most of the commodities or stocks, ETFs, bonds, they're all pretty low right now. So you got individual stocks, which are normally medium to high risk. You're investing in a single company stock. That's normally what it means. ETFs is a list of diversified company stocks. So it's a group of company stocks all in one package, and it's really easy to invest in, and it's pretty much diversified for you. So that's why it's very popular for people who want to do DCA on. DCA is dollar cost averaging for people who don't know what I'm talking about. And ETFs are normally low to medium risk just because it's well diversified. I'd say they're low to medium. Bonds are pretty much a loan from an institute or government normally. So government bonds are normally very popular during a crisis. And maybe if the bond prices start going up a lot, then maybe it's a factor to show us that we are in a recession. Who knows? So those are normally low risk because the rate of returns are normally pretty consistent, and that's why people love it, because people who have a lot of money, they just put into a bond, they just expect passive income, and that's how they want to live their life, just get passive income from their massive capital. And a lot of people are actually happy with that. But not only that, when in a financial crisis, government needs money, so government starts handing out bonds to people, and people buy bonds. And when people buy bonds, they're loaning the government money. So the government then uses that money to drive economic growth. And this normally happens during the bottom stages of a financial crisis to make a recovery back into economic expansion. I will not be focusing on the other options too much, but you got futures, which is pretty much predicting the market, simply speaking. Pretty high risk. Cryptocurrency also very high risk. Was it ever not? Commodities is normally pretty high risk as well. But one thing, gold prices do tend to go up during a recession just because people are squeezed out of stock markets and cash, and normally their other options is gold because they think it's a store of value, and it is a store of value. Bit shaky as time goes on, really, because it's not back in the days where gold was so precious. Nowadays there's a lot of different views about gold. It's still a store of value, and also, yeah, I forgot what I was going to say, but yeah, gold is a reasonable commodity to look into in a crisis like now-ish. Keeping a lot of your money in the bank, especially in your bank savings, there's no risk to this really, but I guess the reason why people do stock markets, ETFs, bonds, and commodities or elsewhere outside the bank is because bank accounts normally don't give you that much good profits. Now, their rate of return is normally a lot lower than inflation, and to match inflation, you should be putting all your money into term deposits so often or something like that. It's very, very crazy to beat inflation with just a bank account, and that's why people look at other options in the financial world. Yeah, it is an option, but it's not an option I would recommend, and that's probably not an option for you, considering that you're watching this video as well. You must be interested in the stock market. So there's two ways you can invest, pretty much anything really, but DCA and lump sum is normally quite two distinctive methods of investing. I wouldn't say lump sum is bad. There is a reputation for lump sum of being bad and very risky. It's all about timing. I don't think DCA is the only way to invest, else everyone would be doing the same thing, just putting money in every like $100 every week or something like that. And I don't know if everyone is happy about that. Some people are willing to take more risk and somewhat trying to time the market and looking for a better gain. Now, if you're looking for a long-term gain, then it might be that if you choose a right time, you might do better with a lump sum than a DCA. You can do a lump sum first, then you can continue to do a DCA. That's no problem. I don't think there is a problem of mixing the two distinctive ways. Just doing one way might make it feel very boring or very risky in some sense, but I think for me, I would be mixing the two methods. So as you know, lump sum is pretty much you're putting all your money at once, or you're putting a decent amount at least in one go at a certain time. So you're normally looking for a better time to put your money into. It's normally called timing the market. I think lump sum is a very common thing that's happening in my hometown, at least in Korea. Lump sum in the stock markets are normally very frowned at because a lot of people lose money that way, because I think Koreans, I'm not sure about other Asian countries, but Koreans love investing for short-term gains, and I think that's really, really risky in that sense. Yes, lump sum is risky if you're looking for short-term. If you only have like few months to maybe a year or two to make a lot of money from your lump sum, then I don't think you're in the right place. Stock markets, you're normally looking at least 5 to 10 years plus, and that's where you should be banking your money on for the long term at least. So as long as it's the long term, doing a lump sum or a dollar cost averaging or a mixture of both is normally not an issue. So for a lump sum, you need a decent amount of capital and a bankroll to keep you going. If you have a stable, high-paying job, then lump sums could be good enough for you. Or you could do a dollar cost averaging with a high value. It's kind of like you're kind of doing like a lump sum level, but you're DCAing that. I mean, if you have that much money, sure, why not? Dollar cost averaging, very simple stuff here. You're pretty much putting money every week or every month, every fortnight or something like that, constantly, and you buy whether the trend goes upwards or downwards. You keep buying it, and it's normally called riding the wave or riding the trend. So it's a very common thing to do on ETFs, and that's exactly why it's so popular, because it's ETFs are very diversified, and you're pretty much putting your money constantly into a diversified fund. Now that's really appealing because in the long term you're looking at a constant kind of annual rate of around 7.5% ish. Some good years does give you 20, 30%, 40% gains, but in bad years you'd get like negative 10, 20, and in a crisis like this you'd be looking at around like 50 to 70% drops maybe. So I think it really depends on when you start investing, but at this point in time I'd be more leaning into a lump sum rather than a dollar cost averaging. If you have the money, I would do a lump sum, and I'll buy some lump sums of stocks, individual stocks. For me, I tend not to go for ETFs during a time like this. I would prefer to bank my money on blue chip companies that are heavily discounted or something like that. Blue chip companies are pretty much small cap companies. What did I say? Blue chip companies are big companies that have a reputational track record in the investment world. There we go, corrected it. So what is the best option for you? It's definitely up to you. Sorry, it is a bit boring. I don't think an investment type or a way of investing fits everyone. Everyone has their own way, favorable way of investing, and I think it's really important of realizing what kind of investor you are, how much risk you're willing to take, and that kind of calculates how much returns you might be expecting in the future. So I think you just got to identify what kind of investor you are, and it makes a lot more sense in the long run. So it really depends if you want low risk or high risk, if you're fine with taking risk, if you're a bit risk averse. You might be only interested in ETFs, you might be only interested in DCAing it, like maybe $50 a week, or not even that, $50 a month. Anyways, if you're investing in the stock market for the long term, you're generally looking at a net positive, so that's the upside of that. If you want to be a bit more low risk, you can look into more blue chip companies, and if you want to mix a bit of volatility and a bit of gambling on top, then you might look for mid to low cap companies. For example, Tesla was also a low mid cap company. It's only recently they started picking up a lot. So that's like the kind of thing you want to be banking on. For example, in New Zealand, you got A2 Milk, which done substantially well over the past decade. And even now, when everything dropped like 50% in the New Zealand market, A2 Milk is actually holding up pretty well. It's because it's essential. People drink milk, and it's simple. And when people buy A2 Milk and they constantly buy their products, they're not going to change it during a crisis. They're going to drink whatever they were drinking for the past decade. And I think it's a really strong business model, and that's why it hasn't been heavily affected by the recent pathogen wiping out the world. So we got that. How much of your wealth you're willing to invest, I think that's really important, of how much you want to invest, either if it's a lump sum, if it's is it 10k, 20k, 5k, 1k. So if you have a lot of money, and if you're looking at a time like now, I personally would just lump sum it into a few blue chip companies and put a bit into small cap companies and just leave it. And I'll just DCA on probably funds or something like that. That's if I had so much money to, have the flexibility of doing all that. But that's what I would do. Short term gains is not really the way at the moment. It's very unpredictable of where the market's going to head in the near future. I personally think it's going to go downwards, but it might go upwards. So your best bet here is banking on the long term. So please look at the long term. It's a safer bet for all of us, and you won't be disappointed if you don't make your money in the next few months, because you know you're in for the long game. And I think it's a strong mental game here, that you keep telling yourself it's a long-term game, not a short-term game. Okay, so I think that's a really strong fact that you must swallow, because it's not a short-term game here. If you don't have much cash saved up, it is kind of hard when you hit rock like this. When you hit a rock and when the financial crisis hits, then if you had money saved up, then you have money to invest when stocks are low. Obviously it doesn't happen often, it happens roughly every decade, but if you had money, then right now is such a good opportunity to make yourself a nice portfolio for the long term. Sadly, I don't have that much cash. I've been putting into property and stuff like that, so it's kind of stuck here for quite a while, but I'm not too unhappy about it. But I am a bit sad that I don't have that much cash to play around with. But hopefully, for me at least, because I think the general market's still gonna go down, I hopefully can save up some money till then, maybe for the rest of this year. I am still working from home during this New Zealand lockdown, so it does give me the flexibility to not panic too much that I don't have that much money to invest, because I still get my paycheck coming in every fortnight. So it's good that if you have money saved up already, now is a perfect chance to come in, and maybe in the near future you might want to have a look and see if you want to DCA it or a lump sum it. Totally up to you. I just want to note one more thing. A lot of people think they'll get like Warren Buffett rich when they come into the stock market. It really depends on your strategy. Now, if you're following everyone else and just doing a boring old DCA on a fund, it's probably not going to make you filthy rich like Warren Buffett, not even close at least. Don't set your expectations so high when you're doing something when what everyone else is doing, because if everyone else is doing the same thing, and if that was guaranteed to make so much money, like millions and millions of dollars, everyone would do it. But it's not. DCA on a fund is pretty much it's going to make you wealthy, but it's not going to make you filthy rich. And I think people need to know that. If you want to get filthy rich, you need to pick a stock or few stocks or several stocks that has so much potential, and you put a decent capital into it. That's literally how you get pretty rich. Like for example, if you put 10,000 bucks into A2 milk a decade ago, you'd be pretty damn rich right now. It's like that kind of stuff that you want to look into if you want to make so much money from the stock market. But yeah, I just wanted to say that because it's ridiculous if everyone could get filthy rich from DCA on a fund. I've been asked that a few times, and it just doesn't work like that. Sorry to pop a lot of bubbles, but it's the hard truth, I guess. And lastly, always do your own research. It is your money. It is your investment. Don't count on other people to make the decisions for you, because they're not really accountable for all that. If things start dropping, it's really the best idea to do your own research, study the market yourself, make some strategies and go along with your own. But look at these videos on YouTube, read some articles, do some learning on TAs, or learning on how to pick out stocks, how to look at balance sheets and stuff like that. That might aid you with your investment strategy. But there's no easy way into this. There is a steep learning curve if you want to do it properly, so please take the time to research and learn yourself. If you like today's video, please let me know. Give me the thumbs up, put a comment down below, subscribe to the channel for further updates. And for people in New Zealand, stay safe, stay indoors, and I'll catch you in the next video. See ya.